G'day folks, welcome back to another update for the German DAX and the Japanese NIKKEI. Now they're both continuing to decline on both charts. We're going to include some backtesting as well in the videos from now on. Before we go any further, make sure you hit that like and subscribe button. In terms of the outlook for today, March 11, the German DAX year-to-date increases of approximately 9.1%, reaching a record high, boosted by nearly $1 trillion in government spending on infrastructure and defence, leading to a significant bond yield increase. Beneficiaries include defence contractors like Rheinmetall, infrastructure firms such as Heidelberg Materials and Siemens Energy, and banks like Deutsche Bank and Commerzbank. For the NIKKEI, experienced a 2% decline to 36,282 points amid a broad market sell-off. Major contributors to the downturn include significant losses in companies like SoftBank Group, down 5%, Sony and Hitachi, both down nearly 4%. Despite recent declines, projections suggest a potential 4.6% rise by end of June 2025, anticipating stronger corporate outlooks once uncertainties over US tariff policy are resolved. So first looking at the German DAX on the monthly, we've got still a very bullish move with the price above its moving averages, and also on the CCI 150 down here, you can see that's also above the moving averages with the exception of that little area where it dipped into the moving averages. And that was a result of this little dip on the price. So monthly, still very strongly bullish. On the weekly, we've got this developing. We've got this potential bearish divergence. Now, if that's almost about the same as where it is now in terms of height on the CCI, the peaks. So that's almost a double top there. You can call that a double top on the CCI versus higher highs on the price. Now, I've drawn a Fibonacci here, and I've drawn a target area. That's a 23.38% level. So we expect that assuming it starts pulling back from where it is at the moment, of course it could go higher, but assuming it starts pulling back, and on the weekly you can see they've got a red candle indicating weakness this week so far, and also the CCI dropping towards the moving average. We expect it to pull into this 23.38% level. I'll just remove this Fibonacci to make it a bit cleaner, but that's the minimum range we expect it to pull back. Now it could do something like this. It could actually just bounce onto the moving averages and bounce out again. Alternatively, if it breaks a lot lower below, then we're going to see further decline. So we'll take it one step at a time. So that's where we are on the weekly. On the daily, we did draw this resistance up here at 23.10. It hit that resistance and it's bounced down. And again, I've got a few other bearish divergences here, which all have been hits. And you can see how they all hit that 23.38% range and then bounced out. And the latest one I've got here is this current one. And this is a longer term one, but this is where it is at the moment. And it's actually technically probably already hit it with those wicks on those candles. But at the moment today, still bullish, a little bullish candle, but we might see further downside. The CCI is still dropping. I've got some plus and crosses here and ticks. I'll explain what they are in a minute. But first we go to the intraday chart. Look at the micro level, even if you're trading on the daily. So we'll still look at the micro or the 1 hour chart, because here you can see very clearly we've got higher highs on the price versus lower highs on the CCI, and the CCI is still dropping, and that also caused the price as well to pull back. So at the moment, I won't draw Fibonacci, but you can see there it's gone well past the 61% level. It's having a bit of a retrace at the moment, but again, I wouldn't be going long. We only trade in the direction of the higher time frame, and that's what this indicates here. So at the moment, because of this bearish move here, if this breaks below the moving averages, then we're going to take short trades only. And that's why I've got a cross. You don't take short trades yet. We want to see the price break below. And that's what those crosses there mean as well. Even though the CCI broke below, the price was still above the moving averages up here. Another period there, the price was above, and the CCI broke below. Where these ticks are shown, that's where you would have gone long. So the price is above the moving averages, and so is the CCI. Each of those places you would have gone long on the daily time frame, and I'll give you some back testing now. So what we have here on the 1 hour chart, I've got two back tests. I've got one for the stop loss approach and one for the average down approach. And for the stop loss approach, we take long trades on the 1 hour chart. I'll demonstrate here on the daily when the CCI and the price are broken above the moving average on the 1 hour, and the daily is showing a bullish move like it was back here. We take long trades on the 1 hour as well. We haven't taken any short trades here, again, because we want to see the price break below the moving averages as well as the CCI to take short trades. So it's all long trades on here. But at the moment, the daily is showing a potential break to the downside. And if it does continue further to the downside in the coming hours, we'll start taking short trades. But at the moment, long trades only. And what I've got up here, as I said, is the stop loss approach. Each of these bars represents entries in and out of the trade, and where the profitability drops off, that means that you've had a bit of a loss, with the exception of this little area. Those trades, you would have made a little gain, and so on. Now, these red areas, these red rectangles, I've marked because that's where you would have stopped the program. So there, for example, is indicated by this period back here on the daily, where you would have stopped taking long positions. So you would have stopped taking long positions there on the average down approach and also the stop loss approach. Then you would have started again long positions from that point on, as indicated by the daily. Now, so that's the stop loss approach, and the take profit is 0.003% for the 1 hour, and yeah, the stop loss is when the price goes against you on the CCI. The average down approach is you enter the same one trade to begin with. I'll just use that as an example there. Let me just zoom into that. You can see that was one contract entered in that period, and then when the price falls by 0.005% and it meets further bullish requirements with the price and the CCI breaking above, it would have entered another, so multiply the first one by 2, so 2 plus 1 is 3, so that would have been 3 positions. And then when it averages down again, when another entry condition is made and more than 0.005% decline, you enter 4 plus the 3, which is now 7 contracts. In this example, that closed out. So you can see there in terms of profitability, the average down approach has generated, if you look at that profitability there, it generated, the baseline is 100,000, but it generated $1,212, whereas the stop loss approach up here, same period, you went backwards, you went back about $450, so you're in a negative. So again, zooming out to the complete period, from starting back from here to where we are today, you would have avoided these trades. So if you took those out, you just would have connected that profitability down to there and that profitability down to there. You can sort of eyeball it and you can see where we stand at the moment. So even if you let it run the complete period without stopping it out on those periods, this one generated 49,396, and on this one you're in the negative by about $400. So for the Japanese Nikkei on the monthly, it's actually broken into that moving average range of the price chart. The CCI, we had a bearish divergence here. The CCI broke into that back in July 2024, and the price actually pulled back, hit that target area with that long wick on in August 2024, and since then it's been consolidating sideways, and it's finally current month it's actually broken to the downside into that moving average range. The CCI keeps declining on the monthly, so we're going to see probably more downside in the coming weeks and months on the Nikkei. So always pay attention to these bearish or bullish divergence, and this one was bearish. We had another couple of bearish divergence here on the weekly, a couple of long-term ones here. The first one was up to that point, that actually pulled back slightly, and then it bounced out of there. And the second one was up to that point, that also pulled back, and it's hit this range now, and the CCI is still dropping. So it hit it once, bounced out, and now it's currently pulling back again with that CCI falling off on the weekly. If we go to the daily, it bounced off this resistance up here at 46.20. We had a support level down here at 37.265. It bounced off that a couple of times, and it finally broke to the downside since our last video. And you can see there since when it broke below the CCI there, it's been declining and below the moving averages of the CCI, and so was the price. So bearish trades, and that's why I've marked it there with a tick. Bearish trades only to be taken from that period. Now if we go to the 1 hour chart, we always look at the micro level. We have a bullish divergence here on the 1 hour chart, higher lows on the CCI versus lower lows on the price. Bounced, hit our target, went a bit higher, and then it finally broke to the downside again and continued to the downside. Now at the moment, the 1 hour is showing a bit of a bullish move to the upside, but again, the price is still below the moving averages. So at the moment, we don't take long trades, we only continue with short trades as shown by the daily trend. So in terms of the back testing, so again on the 1 hour chart, we've got the stop loss approach at the top here and also the average down approach here, and we maxed out to 15 contracts. So you can see there where it's averaging down on each of those periods. Now again, taking short entries only from that point where that tick is on the daily, which coincides with this period on the 1 hour time frame. So here you can see there it averaged down, and that maxed out here to 15 contracts on the average down approach. And you can see here on the stop loss approach. So again, the stop loss method is where if you're going short, again demonstrating on the daily, but it's what you do on the 1 hour time frame. If you're going short in alignment with the price below the moving average, and so the CCI is below the moving average, you stop it when the CCI breaks into that moving average range. That's the stop where you close the contract or you close the position. Or if it hits a 0.003% gain on the short side, you close the position. And that's what the stop loss is doing up here. You can see there, it started off about break even for a number of days, and then it started declining. And at the moment, you'd be down about $6,000. If the baseline is 100,000, you're down about $6,000 on profitability. Whereas the stop loss approach, you can see there it's averaged down a few times there, another few, one average down there, a couple of average downs there. This would have been your biggest drawdown. Now, we didn't close it out here because notice the daily was still declining. If this had touched broken into the moving average like it did back here, for example, we would have closed out the position, and that would have been closed out with a loss even. So you still stop it. You still stop the average down approach if it goes against you. So you don't let it run forever. There's still a stop loss strategy applied to the average down approach. But in this case, because the daily was still declining, we'll let it go. Now in this case, it maxed out to 15 contracts. You don't want to add too many. You would have been down about quite a few dollars on that one. That would have been down about 40 grand. So again, you've got to make sure you've got a big enough bank account to absorb this. And then once it actually retraced back to the downside, it closed out with a profit. And at the moment, you can see there, if the baseline is 100,000, you would have made 77,744 versus the stop loss approach, you would have been in a loss with about $6,000. So again, stop loss does apply to the average down approach, but you've got to be very tactical in terms of where you apply it, and make sure you've got a big enough bank balance to absorb the drawdown. The other thing to note about this is the Japanese Nikkei has got a big margin requirement. So maybe if you want to trade anything, make sure the margin requirements are relatively affordable for your bank account, or depending on your trading bank balance.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.